Thursday, January 7th, 2021. Pursuant to Section 84-1411 of the Nebraska statutes, notice of this meeting was given. Notice of this meeting was given on Thursday, December 3rd, 2020. Pursuant to Section 84-1411 of the Nebraska statutes, the next regular meeting of the Board of Trustees will be held Thursday, February 4th, 2021 at 4 p.m. in the Board Conference Room, second floor at the Teacher Administrative Center, 3215 Cumming Street here in Omaha. The agenda will be kept current and available for public inspection in the retirement office at the Teacher Administrative Center during regular working hours. Pursuant to Section 84-1412 of the Nebraska statutes, the public is hereby informed that a current copy of the Nebraska Open Meetings Act is posted on the Board of Education meeting room on the north wall. So with that, Cecilia, would you please call the roll?
Bourne.
Here.
Havlovic.
Here.
Hersenbach.
Here.
Johnson. Here. Logan. Playcheck. He's on his way. And Ray.
Here.
6 present.
All right. Thank you, Cecilia. Moving down to the agenda, Cecilia sent the board packet recently. Included in that was the meeting minutes. Does anyone have any comments or changes or adjustments to the December 3rd, 2020 regular meeting minutes?
Mr. Chair, if I just may say that the minutes before the board reflect a change that it was Peter Langdon present at the December meeting and not Bob Bothy.
Okay. Any other changes or seeing none? I'd look for a motion to adopt the December 3rd, 2020 meeting minutes.
Move approval of minutes.
A motion.
Second.
We have a motion and a second. Any further discussion? Seeing none, Cecilia, would you call the roll?
Mr. Hersenbach.
Aye.
Mr. Havlovic.
Aye.
Ms. Johnson.
Aye.
Mr. Ray.
Aye.
Dr. Logan. Mr. Bourne.
Aye.
6 ayes.
All right, they are approved. Agenda item number 3, discussion on financial statements for September and October of 2020. Cecilia, would you go through those statements?
Before you are the financial statements as prepared by accounting. For the month ending September 30, 2020, the trust fund had a valuation of $1,350,000 with cash on hand of $12,477,000. For the month ending October 31, 2020, the trust fund had a valuation of $1,323,000 with cash on hand of $12,936,000. I do want to remind everyone that the October financials reflect the September investment activity. And that is the report.
All right, thank you. So now we're going to move down to agenda items 4 and 5. We'll kind of have these together. So with us today to discuss the third quarter 2020 portfolio performance and a discussion on the capital markets are Michael Waldman-Newman, the Nebraska State Investment Officer, and Max Coterie with Aon. So with that, Michael and Max, we'll let you take it away.
Thanks very much. I can see just some of you. I assume you can hear me fine. Good. Max is going to make the presentation today, but I wanted to say, because I have not met all of you face-to-face.
Michael, you're fading out for some reason.
Sorry?
We can barely hear you.
Yeah, I can barely hear you too.
She's fixing.
I'll just speak louder. How's that?
We're good. We're good.
Okay. What I wanted to say is, because I have not met some of you face-to-face, I look forward to maybe at least 6 months from now getting over 20 meetings in person and taking care of that. I also wanted to tell you how successful we think this transition has been over the last 4 years now, and really appreciate Cecilia's participation on our board of directors. So I want you to know you're well represented at the Nebraska Investment Council. With that, Max is going to make the presentation for you today on performance and Aon's capital market assumptions. So again, thanks very much for the cooperation between the Investment Council and OSERS.
Well, thanks, Michael, and good afternoon, everybody. Just wanted to make sure before I start, can you all hear me okay? Perfect. Okay, so I'm going to spend, it is now January 7th of 2021, and we've got performance results through 9/30/2020, so I'm not going to spend a ton of time on them. I'm only going to hit a handful of slides, and then we'll spend the rest of the time talking about the capital market assumptions. But if you do have any questions on any of the performances I go through it, please speak up. So I'm going to try to share my screen here, and let me know if this isn't working, but I'm hoping. Give me 1 second. Can you now see a performance page that says OSER Summary of Transition Activity during 3Q on the top?
Yes, we do.
Can you make that larger?
Perfect.
Can you make that larger, please?
Okay. Can everybody see it okay?
Can you make it larger, please?
It's my full screen, so I'm afraid this is about as large as I can make it on my computer. And I think folks, Cecilia, correct me if I'm wrong, I can see it in the bottom corner here, but I think folks may have hard copies of this as well, if it's easier to follow along on that.
Yes, you should have hard copies of what he's going to put up.
Great. So we sent along a packet that has 3 sections. The first section is just a broad market environment, and again, as that data is through 9/30/2020, I see no need to go through that here. The second section is a broader set of materials that the council reviews, and again, I think that's really not applicable here. I was going to spend my time on the third section here and just highlight a few pages, and the third section is specific to the OSERS portfolio. And this slide that we've got up on the screen now, Michael had referenced sort of the transition that's been going on over the past few years, and we just wanted to show sort of the progress in that transition, and also sort of the amount of distance we still have to go. And it also provides a helpful backdrop for some of the relative performance you're going to see in a minute, both relative to benchmark and relative to peers. One of the, not to bury the lead, one of the major differences between your portfolio's performance and the average peer performance and the NPERS portfolio performance is the amount of assets that have been in illiquid assets over much of the past decade. And so on this page, what you're seeing on the far left there, that allocation as of 12/31/16, that was the asset allocation right before the OSERS portfolio came over under the council's supervision. And then we show sort of stepwise several stages of the transition. And if you move over to the third column from the right and look at allocation as of 9/30/20, that's where we were when this report was run, and you can see the illiquids allocation, which is basically the legacy hedge fund piece, which is about 0.5%, and then real assets, real estate, and private equity sums to just under 25% at this point, and that's down from about 50% as of 4 years ago. So when we first started this transition, we thought it would take anywhere from 7 to 10 years to sort of go all the way from where we were to the NPERS long-term targets, which were adopted for this portfolio here. We're about halfway through that transition at this point. We still got about twice as much in illiquids as the NPERS portfolio, but it's certainly come down quite a bit from when the portfolio first moved over. I'm going to, and again, apologies for jumping around for those of you that are following along on hard copies, but if you move to page 37, if you're following along on hard copies, just wanted to sort of briefly provide an overview of year-to-date performance for this portfolio at a very high level. And so, again, focusing on that second column from the left, year-to-date, you can see this portfolio was about flat through 9/30. Which, sort of nothing to be excited about, is certainly quite a bit better than things were looking as of 1Q when all markets were down severely. So this portfolio, as of 9/30, had just gotten its head back above water ever so slightly. If you look at the various performance of the asset classes, One thing we'd note here is value stocks have performed much, much differently than growth stocks, at least through 9/30. That's persisted through the end of the year. But as of 9/30, the difference was fairly dramatic. So on a whole, U.S. value stocks had underperformed U.S. growth stocks by about 35%. And so there's a few managers that are standing out here, like Dimensional, DFA, under the U.S. equity allocation, and then Dodge & Cox and Wellington under the global equity allocation, that tend to have a pretty heavy value bias. And here they're being measured against broad market benchmarks, and that's really driving a lot of the underperformance that you're seeing here. Value stocks did start to rally pretty strongly during 4Q, and we do think that value stocks will likely come back over time, but it did lead to a fair amount of underperformance year to date through 9/30. The other thing I would mention here, and this has been sort of more of a long-term phenomenon, and maybe before I do, if you move forward to page 38, one thing I would note is this portfolio's fixed income allocation was kept very, very high quality. So all of the mandates here are sort of aggregate bond mandates or focused heavily on investment grade. And that was done because some of the other legacy positions we thought might have a little bit more risk in them. But that is certainly done well for this portfolio this year. You can see the bond allocation is up nearly 7% and about 80 basis points ahead of benchmark. And that is quite a bit better, actually, than the NPERS defined benefit plans bond allocation is done, because that portfolio has a little bit more risk in the fixed income allocation. The other thing I did want to mention, if you look over sort of these longer-term periods, so if you look over a 3-year period or a 5-year period that we show here, you can see some of the legacy illiquids, so the hedge fund composite versus its benchmark, the real assets composite versus its benchmark, a little bit to a lesser degree, but private equity versus its benchmark, and then on the following page, the real estate composite versus its benchmark. These legacy illiquid portfolios have tended to struggle relative to the benchmarks that they're measured against. And so while you've seen some value equity have some impact on relative performance in more recent periods, if you look at the longer-term underperformance of OSERS relative to its policy index, it's really being driven by those legacy illiquid positions. And then maybe the last thing I'd mention before opening up to questions, so we do periodically look at performance relative to a peer universe. So what you're seeing on 36 is the performance of the portfolio, which is the blue squares, and the policy benchmark, which is the green circles. And it is ranked in a peer universe of other public funds with more than $1 billion in assets. And you can see over sort of the longer term periods here, if you look at 3 years, 5 years, and 10 years, those that performance has tended to rank sort of toward the bottom of that universe, and that these are the numbers in parentheses here are the percentile rankings, and you can get the visual if you look toward the top of the page. But the vast majority of that has been driven by so one, having more allocation to private market or sort of alternative assets during a period where traditional assets have done very, very well, and also some underperformance in those private market assets relative to their return targets or the benchmarks that they're measured against. One thing, let me end on a little bit more positive message before opening it up for any questions on performance. But as many of you are probably aware, 4Q was a stellar quarter for markets. So U.S. stocks were up about 15%. International stocks were up about 17.5%. And bonds made small positive gains as well. So I think 4Q is going to be a very, very strong quarter for this portfolio. Year to date through 9/30, the portfolio was only up 0.1%. But I'd say you've got a better than average chance of actually, on a calendar year basis, calendar year 2020, hitting that 7.5% return target for a 1 year basis. I think the 4Q return for this portfolio is going to be 7+%, high single digits. So I think we'll end up having a reasonable year 2020 based on 4Q strength. Let me go ahead and stop there. I'm happy to take any questions anybody may have on performance. If there are none, we can move forward and talk a little bit about capital market assumptions.
Okay, Max, if you could just take 90 seconds to just kind of bring them up to speed on the transition of the SPC portfolio in the private equity and the transition over to Hamilton Lane.
Sure. So on that one, we still note here SPC Capital is the portfolio that you're seeing here, and we if you had eagle eyes, which I realize is probably hard given the screen, you'd see a footnote that says SPC is currently being wound down by Hamilton Lane. So that SPC vehicle is a private equity fund of funds. Over the past year, we look to replace the general partner of that fund with Hamilton Lane, which is an entity that we viewed as sort of more institutional quality to sort of manage the wind down process. So to be clear, SPC Capital was not making any new investments at this point. It was just monitoring the existing investments and managing cash flows. So meeting capital calls and receiving distributions. We have, we've sort of assisted the council, but the council ultimately appointed Hamilton Lane to step in for SPC to manage that process on a go-forward basis.
Thank you.
And if I could add just a little, Cecilia, tell me you can hear me fine.
Yes, we're good.
Just to add a little bit more color on that, for your new trustees, the SPC portfolio that Hamilton Lane has taken over as manager still has probably 10 years or so to run. And what we have done with the former manager is we've begun making payments to that manager, not in manager fees, but in the interest that he has on the profit generated inside of that portfolio. And he will continue to have those payments, now that we've begun, flow to him per the contract. And as I say, I anticipate that to continue for perhaps 10 years. The other portfolio that he manages is the Stonetree Portfolio. And the Stonetree Portfolio we expect to wind down within the next 3 years. So just so you know, in terms of the length of these illiquid assets that we inherited when the council took over from OSERS, we're doing our best to get those portfolios wound down, to transition the OSERS portfolio as quickly as we can to mirror the council pension portfolio, so that Omaha school employees are in the same asset allocation as the rest of school employees throughout Nebraska. But as you saw in the column table, the transition is still ongoing. But specific to Stonetree and SPC, we've replaced the manager with Hamilton Lane for SPC going forward. And for Stonetree, we undertook a further analysis with Aon on weaknesses we found in the infrastructure of SPC and cured the primary concerns we had with that to strengthen the management in Stonetree through the rest of the investment period, which I say is another 2 to 3 years, just to reassure OSERS that we're monitoring these assets and trying to strengthen, getting out of them as quickly as we can, with no loss to the portfolio, but also strengthening those where we can to ensure that OSERS has the best legacy portfolio during the transition and unwinding period. Thanks.
Thanks, Michael. That was, I think, a very, very helpful summary. Cecilia, were there any other questions in the room on performance, or should I put up the capital markets presentation?
It looks like we can move to capital markets.
Wonderful. Let's see if I can do that. Okay, can everybody see a page that says capital market assumptions on the top? Okay, perfect. So this one, the font's a little bit bigger, so hopefully it's a little bit easier on the eyes. This is an excerpt from the presentation that was presented to the council in September. And just for those that may be new to the OSERS board, every year, using our assumptions that align with the council's fiscal year end, we provide an overview of our capital market assumptions, and then we apply them to the council's long-term asset allocation for various asset pools that are under their oversight to come up with what we think our best guess for what long-term returns might be for the portfolio. We also try to provide a range of outcomes sort of around that best guess. So just as a quick primer before we dive into the numbers here, we produce assumptions for asset class returns, asset class volatility, and correlation between asset classes. We produce those assumptions on both a 10 and 30-year basis. They are forward-looking. We don't just look at what asset classes have returned historically. We're looking at sort of a best estimate. So we've got what we're going to show here are median assumptions, but we'll also provide ranges of reasonableness around those assumptions when we look at the total portfolio level. We just look to provide market returns. We're not looking to add or subtract sort of manager performance at this point. We're just looking at sort of broad markets and what the asset allocation might earn. And as mentioned previously, we update our assumptions quarterly, but we only present them to the council once a year at a date that aligns with the council's fiscal year end. So to get right to it, these are our 10-year assumptions for major asset classes and making sure that we cover the asset classes that you find in both the NPERS and the OSERS portfolio. I won't go through all of these, but we've got the 10-year geometric nominal return assumption, and we've got the 10-year volatility or standard deviation assumption as well. Just a couple comments that make it a very high level is our assumed returns for equities are as low as I've seen them since I've been at the firm, and that goes back nearly 20 years. You can see our 10-year forward-looking assumption for U.S. stocks is about 6%. For developed international stocks, it's about 7%. And for emerging markets equity, it's a little bit higher, about 7.7. So those assumptions are sort of quite depressed relative to what they might have been a decade ago, and we'll take a look at that here in a moment as well. The bigger issue, I think, and the bigger problem from a trying to meet return hurdle perspective is the fixed income assumptions, and our fixed income assumptions are exceptionally low, and most folks in the industry are. And so if you look at the core fixed income assumption that we have right now, we think over the next 10 years, best guess is you're only going to earn a little bit more than 1% on a high-quality bond portfolio. And so if you go down to the bottom of the page, you can see that is even sort of sub-inflation. So you're losing money in real terms on assets that you have in high-quality fixed income. And because you need to have part of your portfolio in conservative assets to ensure liquidity and to help you ride out downturns, having a piece of your portfolio that we think is only going to earn 1% or so makes it very, very difficult to get to a number like 7.5 at the total portfolio level, because that means the rest of your assets need to be earning closer to 10% to get, if you got a 20-30% of your portfolio that's earning 1%. I won't spend much time. Happy to answer questions at the end, but we've got other assumptions for asset classes that are either in the portfolio or you find in other institutional portfolios here. The high-yield bond and emerging market bond, those returns tend to fall in between sort of stocks and bonds. And then you can see we've got alternatives as well. Our hedge fund assumptions are pretty low. Real estate is sort of equity-like. This includes core real estate, core private real estate, as well as some sort of higher octane value add or opportunistic real estate, similar to what you have in your portfolio. And then you can see private equity is our highest assumption, but still not a terribly high expectation, sort of given the risk that's involved in private equity. I'll move more quickly through slide 4 because really the only difference between 3 and 4 is looking out over a longer period. These are our 30-year assumptions versus our 10-year assumptions that I was walking through previously. And I mentioned before that our 10-year assumptions are very, very low across asset classes. You'll notice our 30-year assumptions are low as well, but they're a bit higher than the 10-year assumptions, and that's because we think we're sort of in an exceptionally low returning period over the next decade or so, and we're building into our 30-year assumptions some expectation that will, over the next 30 years, hopefully return back to something approximating quote-unquote more normal. So our equity assumptions are a little bit higher, our bond assumptions are a little bit higher, and that's a result of years 11 through 30 of our projection sort of returning back toward something that looks a little bit more like historical returns from those asset classes. So if you take our long-term policy allocation, and again, it's important to remember here for the OSERS portfolio that the current portfolio is not necessarily all that close to the long-term target allocations. It's getting closer, but we've got closer to 25% in private equity and real estate, so we've got more money in those asset classes and less money in some of the more traditional asset classes. So these forecasts, while there are always going to be some error bands around them for the OSERS portfolio, those error bands will necessarily be wider. But you can see based on the long-term policy allocation that we're hoping to get to in the next 4 or 5 years or so, our best guess median outcome return for the portfolio would be between 5.5% and 6%, and with a standard deviation of about 12.3%. So obviously lower than the current target. I know there's been some discussions about lowering the current assumed rate, but our best guess is quite a bit sort of lower than the 7.5 over the next 10 years. The 30-year number gets a little bit rosier. You can see we go from 5.7 to 6.3, but again, still falling short on a median case of the existing 7.5% assumed rate. And if you go to the next slide, I mentioned earlier that we try to provide ranges around our median assumptions. I should point out, if I haven't made it sort of clear already, that forecasting capital market returns is very difficult. It's a lot more art than science, and so while we do provide a median forecast point, which in this case is 5.7% over the next 10 years and 6.3% over the next 30 years, there's going to be sort of error bands around those forecasts, and if we can guarantee anything, it's that our median forecast is not going to be on the nose. We're going to come in somewhere above that or below that, and so to try to provide a sense for how far off we think our forecast could be, we provided a percentile distribution around our 10 and 30-year forecast. So the way to read this is the 5th percentile or the 95th percentile, the way we've labeled it here, outcome. So if we have sort of the best possible economic environment over the next 10 years, we think that the portfolio could actually return double digits, something around 12%. If we're in the 25th percentile of our forecast, and here again, sorry, it's labeled the other way, 75th percentile, but if we have a better than average expected outcome, but maybe not the best possible outcome, we think you could earn about 8%. So there's a 25% chance you're going to earn 8.3% or higher. If we have a 25th percentile outcome, again, if we come in below our median, we think there's a 25% chance you could earn 3.1% or lower. And if we have about the worst possible economic outcome that we can imagine over the next 10 years, we think there's a possibility that this portfolio could actually produce a negative return. And then we've got the same sort of distribution on a 30-year basis. The longer your time horizon gets, sort of the tighter that distribution gets, as you can see in the graph on the right. And then finally, just, and again, I realize there's some discussions going on about the assumed rate, but just to put some context around this distribution, we think if you were to plot where 7.5 falls in this range, we think there's about a 30% chance, based on our capital market assumptions, that the current portfolio would earn 7.5% over the next 10 or 30 years. So a 1 in 3 chance of hitting that existing assumed rate. Let me just hit a couple more slides here, and then we'll open it up to any questions. But I mentioned that our current assumptions were about as low as I've seen for several asset classes. Just to provide some numbers to that, we provide our capital market assumptions across asset classes over the last decade. On the far right here, this is what our assumptions for return assumptions for various asset classes, our 10-year assumptions were 10 years ago. And then moving from right to left, if that assumption goes down, we've coded it in red. If it goes up, we've coded it in green. And you can see if you compare the 2011 column, so our assumptions a decade ago, to the today column, 6/30/20, you can see across the board our assumed returns are lower, and equities are anywhere from 2 to 2.5% or so lower. Fixed income, depending upon the asset class, again, anywhere from maybe 1% to 2% lower in the bond portfolio. Two final slides I wanted to mention here, and I think this makes the point that I referenced earlier.
Can I ask a question before you
getting to 7.5
Max,
becomes
1
pretty,
second.
Yeah,
Max?
I'm sorry.
Yeah, I got. Can you hear me, Max?
Yes, I can.
Okay, can I ask a real quick question?
Shoot.
So on your chart where you talked about there's a 30% chance of hitting the 7.5%.
Yes.
Do you have that number for say 7%?
Yep. I don't have it handy, but I can absolutely follow up after this meeting with that number.
Okay. Just curious if we're thinking about changing the rate, where 7% would fall in that, and then 6.5 would be the other option probably. So, which is you probably already have because it's close to 6.3. But thank you.
Yep, I can, if it's helpful, Cecilia, I can send you where both 7 and 6.5 fall in this distribution, and then you can circulate it to the board.
Excellent. Thanks.
Perfect. Let me just hit a couple of additional slides here, and then I'll make 1 or 2 other comments that open up to questions. But as I was alluding to earlier, the problem is that there are asset classes out there that we think can earn you 7.5%, 8%, but they're few and far between. And you can see on the far right of this page, private equity and emerging markets equity are about the only things that we think can get you in that range, given current market conditions. But if you want to build a portfolio that's not sort of wildly risky, you need to have some assets allocated to things like core fixed income or treasuries. And anything that you put in an asset class that's going to earn sort of 1 or 2%, you need your other assets to be earning like 10% to get you to 7.5. So I think this is just a visual illustration of the difficulty of meeting sort of return targets in the current environment, in our view. One other comment I'll make, we didn't include this exhibit here, but one question we often get is, well, these are your assumptions. Who knows if they're right? Very fair question. Building capital market assumptions is very difficult. I don't know that this will show you that our assumptions are right or not, but we do plot our assumptions against other industry assumptions every year just to see how we stack up relative to other consultants and other folks that are in our same role. I can follow up with that exhibit as well if that's of interest. The long and short of it is our assumptions are sort of right in line with about 3 dozen other peers in the industry that submitted their assumptions to a database that tabulates these things. And if anything, our assumptions are actually slightly on the high side relative to industry averages. The last slide I wanted to hit here, I realized, and again, I excerpted this from a presentation that was made regarding the NPERS portfolio. The same points I think are valid to OSERS. So obviously, when you're thinking about return assumptions, you want to think about what capital market assumptions are saying you're likely to earn. But it's also helpful to look at what peers are doing. And so what this chart is showing is what public fund return assumptions have been over the last 20 years. And so there's anywhere from 150 to 200 data points per year. So this is looking at public funds over the past 20 years, and the data sets, again, about a couple hundred public funds. And the way to read this chart is the black diamond in the middle of these, each annual sort of chart here is the median public fund assumption in that year. The blue square around that, the edge of the square is the 75th and 25th percentile public fund assumption, and then the very ends are the 5th and 95th percentile assumptions. And so what you can see here is over the 2000s, the median assumption for public funds was pretty consistently 8. And then toward the back half of the 2000s, you started to see that move down. In the early 2010s, it dropped from 8 to 7 3/4, and then from 7 3/4 to 7 1/2. A few years ago, it dropped from 7 1/2 to 7 1/4. And if you were to project this out another year or two, I think it's highly likely that we're going to see the median assumption either next year or the year after will become 7. And so 7 will effectively become the new 8, and I think that you're going to continue to see a sort of a trend in lower average assumptions amongst public funds.
Do you have any?
Let me, Cecilia,
Max, one
I'm sorry,
second.
Do you have any commentary on why the 5th percentile actually went up a little bit between 18 and 19?
Yep. My guess would be, and this is maybe a little bit speculative, but there are a couple of public funds out there that have really lowered their return assumptions. And when we gathered this data, we only had about 3/4 of the universe of public funds reporting. So if this number in parentheses along the very bottom, if you can see that the hand icon there, that is the number of funds in the data set. And you can see we only had about 3/4 of them when we gathered the data for 2019. So if I had to guess, I would say 1 or 2 of those funds that have a very low return assumption, like in the 6 range, hadn't reported yet. And so that's why you saw the tick back up.
Okay, thanks.
Cecilia, I'm afraid I may have run longer than I was supposed to, so let me stop there, but I'm happy to try to answer any questions that any of the board members or you may have.
I do have a question. This is Roger Ray. I just had a question on the returns that we saw. Are those net of inflation, or is those including inflation? When you see the equity returns, should we add inflation back to that for expected returns?
These are all nominal returns here. So the 5.7 and the 6.3 that you're seeing here are nominal. If you were talking real returns, our inflation expectations right around 2. So you'd be about about a little under 4 and a little over 4 on a real basis.
Okay, thank you. Second question: if bonds are expected to return such a small amount over the next 5 or 10 years, is there a magic number about how much percentage you should have allocated to bonds that the investment council is using, or is that something that's fluid and can be changed quickly?
It's a great question, and it's something that we'll be reviewing. So we show here, and again, you probably can't see the footnote because it's going to be probably small on your screen, but we show 30% in fixed income, but really only 20% of that is in sort of very conservative fixed income, and the other 10 is in higher yielding fixed income. The amount that's in the more conservative, the 20% that's in the very conservative fixed income, we use an asset liability study to help us land on that number, and we will be having another asset liability study for the NPERS plan over the coming year. So that 80-20 split of risky assets, less risky assets will be reviewed in the coming year. And then the fixed income portfolio in its entirety, sort of what's in it, how risky it is actually currently under review by the council, in part because we've entered into such a low sort of yield environment. So maybe a long-winded way of saying that it's not set in stone, and the machinations to review sort of those allocations will be underway in 2021.
And how quickly can they respond to changes?
I'm sorry, was the question how quickly could we respond to changes?
If the investment council decides to make a decision, how quickly can the investment council make that decision, and how quickly can you implement their recommendations?
I think it's the making the decision that takes time. Implementing the fixed income allocation should be relatively straightforward, making changes, but the council tends to have a pretty long time horizon. So any changes to long-term targets are going to be sort of considered and sort of reviewed over a couple meetings. So I would say the decision to make the changes is probably not a rapid one. Implementing any changes that the council decides to make should be relatively straightforward.
Cecilia,
Yes?
let me add a little bit. Roger and Elaine know this, but the way we manage the asset allocation at the Investment Council is to undertake on a 5-year rotating cycle a deep holistic review of the asset allocation, asset class by asset class. And as Max alluded to, the review of each asset class's allocation within the portfolio can take up to a year or more on the part of the Investment Council staff, and then in collaboration with Aon, our consultant, to come up with the structure of the asset allocation. And then once in place, my preference as the SIO and our past practice has been to leave that allocation in place for a 5-year period, which is what we consider a market cycle in our policies. So it's, as Max said, the deep dive and long-term study to arrive at the structure is what takes the time. And embedded in that is also education with the council to be comfortable to implement the structure. So the hiring and firing of the managers, once we develop the structure, doesn't take as much time as the development of the structure itself. Because as we know, manager selection is a small part of the success of a portfolio. It's the development of the allocation and the structure and foundation of the portfolio that produces the long-term return within what we consider the proper risk. So what Max said is true. We are right now in the middle of an examination of our fixed income structure, which began last year and will be completed perhaps by June, where the council makes the hire-fire decision on implementing the structure and the managers, maybe not until September. And then once that happens, we'll leave that in place for a period of time. So we're not investment managers who turn on a dime and make snap decisions, because after all, our time horizon is infinite. And as I said, when I came to visit the board now 4 years ago, we're investing this portfolio not for retired teachers or current teachers, but in fact the teachers who are not yet born. Thanks.
All right, any further questions?
Michael, this is Roger Ray again. I do have a question about class action lawsuits, but perhaps that's a discussion you and I might have offline. Is it okay if I email you those questions?
Sure, okay. You bet.
All right, thank you.
But I can tell you now, well, no, why don't you go ahead and send me what it is you'd like. We do discuss legal matters in closed session at the council.
This is simply a matter of, do we participate in class action lawsuits, and if so, what is our...
Yeah. Okay,
what do we
that I can answer. We have relationships with, the answer is yes. We do participate in class action lawsuits. The majority of class action lawsuits are routine and settled through our custodial bank, and we we receive payments for settlements as they occur. We also have relationships with 2 law firms that monitor for us potential class actions to the extent that the Nebraska Investment Council would want to be lead plaintiff in a class action lawsuit. And you have to remember that as a state agency, our legal representation is through the state attorney general's office. So any decision to participate would come through the attorney general's office. Even retained counsel that we have, that is counsel that is a private law firm in Lincoln, happens to be now. That representation, though, formally comes by having the lawyer in that private law firm be granted assistant attorney general status by the state attorney general's office. And that is renewed each year. Hope that's helpful.
Yeah, thank you. That answers my questions.
Saves you a phone call, Roger.
Okay, any additional questions for Michael or Max? Seeing none, thank you both. Really appreciate the presentation.
Thank you very much for having us. Bye now.
Okay, so we're going to move on the agenda. We're going to go to item number 6. You recall that we had discussed the disability policy. We had discussed the new disability policy 1 or 2 board meetings ago. Additional changes that the board requested, and so I'm going to have Cecilia kind of go through that policy it's on your desk here. I think Roger had mentioned or suggested some changes, and I think we've made those changes, and I'll ask Cecilia to kind of walk through the new disability policy.
Okay, before everybody is disability policy that we looked at last month. There were some suggested changes, and they are before you. On page 1, number 3, I removed any reference to having a secondary review at least every 18 months thereafter. And so it'll just read that the board will have the ability to ask for a review once a year, and leave it at that. On the second page...
Hey, Cecilia, but that's not what it says, right? It says we can review once a year unless we want to review more often.
Correct. Yeah. And we took out the 18 months, and if for some reason someone is warranting a reason to say 6 months after we had a review, we need to look at it again.
So basically it should say we can review anytime we want? That's what it's saying, okay.
Yes. Then on the second page, at the bottom of the page, subparagraph B, regarding future reporting, the number of disability retirements, so part of the report that the executive director will have to give is the number of disability retirements in deferred disability status with an analysis to either age 65 or the capping of 35 years of service for each affected member that's in this status on the report. So basically, it's to make sure that the board is always aware that anyone in deferred status, when will their liability truly hit our books? And then finally, the third page, which is the form, At the bottom of the page, okay, wait. At the bottom of the page was the clarification that the member will be responsible for the cost of the initial physician's visit, and that they understand it when they fill out this application. Those were the three changes.
Okay. Any questions for Cecilia? Roger?
I move that the Board of Trustees adopt the disability policy and procedures as presented.
We have a motion. Do we have a second? All right. Thank you, Matt. Matt seconded it. Any additional discussion, questions, comments? Cecilia, call you heard the motion. Call the roll for approval.
Johnson.
Aye.
Hersenbach.
Aye.
Logan. Ray.
Aye.
Havlovic.
Aye.
Flacek. Bourne.
Aye.
7 ayes.
Okay, the policy is adopted. Moving on to through our agenda, the election service company. When we have OSERS board member elections, this is if there's more than one nomination, we utilize this company's services for that election. Their contract has expired. Cecilia, you want to give some additional details on the contract?
I think you covered it well. It's the same company we have been using since 2017. Again, this contract only goes into effect if there are 2 nominated candidates, 2 or more. If there's only one, we do not go into engage them for their services.
And so the only way that they would be compensated is if there was multiple candidates.
Correct.
Okay.
And just for the listening public, again, there's no cost to OSERS unless there are 2 or more candidates. And notice of nominations, or notice of the nomination period of February 5 through February 12, 2021, will be sent through OPS District Communications for the next 5 weekly email distributions.
Okay, I'd look for a motion to renew the election service company contract for 2021.
I move the Board of Trustees authorize the Executive Director to engage the services of the Election Service Company to oversee the 2021 OSERS trustee election only if 2 or more candidates are nominated for the trustee seat.
We have a motion. Is there a second?
I'll second.
Thank you, Roger. We have a motion and a second to approve the contract. Is there any other discussion? Seeing none, Cecilia, please call the roll.
Hersenbach.
Aye.
Logan. Ray.
Aye.
Flacek.
Aye.
Johnson.
Aye.
Bourne.
Aye.
Havlovic.
Aye.
7 ayes.
Okay, it is approved. With that, we'll move down to agenda item number 8. Jack Peets with Peets & Company is here to discuss the goings-on in the 2021 legislative session. Welcome, Jack.
Thank you. Is it okay? Well, I'll try not to touch anything here. I thank you for the opportunity to visit with you this afternoon. And for those who I haven't met, I'm Jack Peets with Peets & Company. I'm known as the company part of it. It's my wife's firm, so she's make sure that everybody knows it's Peets, and I'm limited to company. And I did not get this mask from anybody in Washington, D.C. yesterday. I think it came from Duluth, but it's pretty good because it doesn't affect your hearing aids, so it doesn't pull them off. I think I sent yesterday evening a list of the what happened in the legislature yesterday, and there were committee appointments. The Committee on Committee came out with the appointments, and usually those are about 95 to 98% accurate. They met again this afternoon, probably at about 1 o'clock, and there's been a number of changes on that. Senator Slama moved off a couple different committees. It really isn't important. You can go to the website and see. The ones that are important, I think, that affect OPS and OSERS is education, Senator Brandt went off of Education, and Senator Sanders, who's a new senator, came on the Education Committee. And that's probably seen as a swap, because I think Senator Brandt is a fan of public education. Sanders, I think, is unknown, and we'll just have to see where she lands. The Education Committee itself had a contested committee election yesterday. They went 2 rounds. One of the senators set out the first voting round, so it was 24-24. Then somebody switched to Senator Walls, a former teacher, a nice lady, a good senator. She'll be good for education, in my opinion. And then whoever it was that set out the first time set out second time too, because there were in a total of 49 votes there. But I think the Education Committee is pretty progressive and pretty supportive of education. So I think education statewide, that was probably a good election. There was no change in the Nebraska retirement systems. There were Senator Slama is on that. She was on 2 other committees and got off of those committees and switched committees today. There were probably about 10 or 12 switches within committees, which is more than normal, but none of those really affect you here. There were 100 and some bills, about 130 bills introduced today, and there were about 11 legislative resolutions or constitutional issues brought up, and I think one of them that you saw was Senator Erdman came back with his consumption tax, getting rid of social income tax, things like that. So you'll see a number of those pop up. Initially, Mike Hilder's in early December, and he was the only one that was declaring that he was interested in being speaker. In deference to the existing speaker, because he was still the speaker until the election yesterday, he sent around a memo and said that if he's successful in becoming speaker, he wanted the senators to, because of COVID and the way that things were going to operate this year, he wanted them to reduce the number of bills that they were introducing. Well, that didn't happen because the bills that were going up late last week to the drafting office were in the getting assigned temporary numbers in the 800 series. Now, all of those bills won't get introduced. There's some of them are duplicates, some of them, and I know we talked to a senator earlier today that had 2 bills that were drawn that were similar, got them back, and has decided not to do anything this year. So 2 years ago, I think we had 776 bills the long session. We were hoping we'd stay into 500 this year because it's not too manageable once you get above that. So there's 800 requests or more up there now. A number of those came back. How many of those will actually surface, I don't know. This is a good number to come in the first day, and everybody that you talk to that didn't drop bills today, and I think Senator Coleman dropped 7 or 8 today, and I think 8 because I think he said he's only going to introduce 16 this year that he's aware of. At this point, he may join on something else. I think they want to get those in to get the hearing early. So there will be they'll start the hearings, and we'll get a little bit more over the weekend from the speakers to how he wants to run things. But 2 things that we do know: he's told everybody that he wants to start hearings on the 19th, the day after, I believe, Martin Luther King holiday. And normally they didn't start hearings until noon. Now they'll start them at 10 o'clock in the morning to try and get them done so they can get bills moved through the system. The other thing is that the former speaker, if you were on a filibuster and you got to 3 hours, you had to show the speaker you had 30 votes to bring it back. I don't think Senator Hilgers is going to do that. I think he's going to go back to the old 8 hours on the first round, 4 hours, 2 hours, which could drag things out. I understand that you did get a copy of some information from Kate in Senator Colderman's office on what he plans on dropping with respect to OSERS and the merger. And I've got a copy of those, and I don't think it's changed, but I did have a chance to visit with the senator today, and items 1 and 2 on those on that list. The one is somewhat of a reconciliation of terms. OPS and OSERS, OPS specifically, is ahead of the game in respect to how they treat retirement and the ability to intermittently work after retirement. And a couple of years ago, the senator, I think, and the committee was trying to move OPS more towards what the state plan did, and that did not go anywhere. It was withdrawn, I think, at a later date. Roger, you may be aware of that. I think now the state is saying that the way OPS does it is the best way to do it, because it allows the school districts to have access to substitutes quicker without jeopardizing that clear termination. So that one is one that you probably want to look at and say, yeah, that's probably anything we wouldn't really object to any of that. The second one is the compliance audits. There is some concern, and I think it's no news to you, on them if they do decide to go forward with the mergers. NPERS wants to make sure that they're merging in a clean plan, and there's not been since I think the 1950s when some of this was first. I think that's maybe when OSERS was first established. There's not been any audits by the same firm and the same consultants that audit the state's plans to show that they're in compliance with the Department of Labor and the IRS rules on termination and that. So NPERS is saying if we're going to take the plan over at some point in the future, we want to make sure we've got a plan that's clean, that doesn't have a potential to get disqualified for some reason. One of Senator Colderman and I think the NPERS group concerns is why there was never an audit since 1951 up until now, and he's aware of the fact that most of the people in this room didn't have anything to do with that until I mean, you've been involved in the last 4 or 5 years, but before that it was managed different than what it is now. So those audits are things that he wants to keep in a separate bill. Those aren't all bad, because I think what you would expect is it'll show that in conjunction with OPS and NPER, or OPS and OSERS have been operating a pretty good plan that's in compliance. They just want to get the state as well as the consultants that do that type of stuff to give their blessing that, yes, the plans are in compliance.
So hold on one second, Jack. So for the committee's benefit, when I was putting together the agenda with Cecilia, I forgot to put on discussion of that audit provision. So we're going to talk about that under new business, just so everybody knows. Okay. Thanks. Please go ahead. I just wanted the committee to know.
There's 2 audits that are listed there. Are there really 2 audits, or is it just one? There's a compliance audit, and it says an audit conducted by the Auditor of Public Accounts. Well, on the sheet here, there's 2 audits listed. Are there really 2, or is it 1?
There's 2 audits. One is done by the state, and one is they do it, I think, Cecilia, I think every 6 to 8 years, but before 10 years, that all of the other plans that the state and NPERS manage, state patrol, judges, and all that, they have RFP put out, and then there's an outfit out of a law firm and a consulting firm back in D.C. that take those plans and look at all the rules, regulations, and how they've actually performed on a day-to-day basis in conjunction with those rules and regulations. And they say the rules and regulations meet.
I understand what that means. So there's a compliance audit, and then what's the second audit conducted by the Auditor of what's public accounts?
That's one that they do with the other state plans, and I think NPERS is just wanting that in conjunction with the compliance audit. I don't know the nature of that, although I think that
the state
Kate
auditor
sent a sample of that.
Yeah. So if I may, the one is conducted by a law firm / actuarial firm looking at compliance, so that's a separate one. And then the one conducted by the state auditor is also more of an operational, financial look through of the plan.
Okay.
Yeah.
We can talk about more later. I just don't understand the difference between the 2. But that's okay. Go ahead.
Pardon?
I said go ahead.
Okay. Item 3. 3 and 4. I'll jump down to 5. 5 real quick is a stakeholders bill or a placeholders bill. And for those of you that aren't familiar with the legislature on the retirement, anytime you're going to do have any legislation with reference to the retirement system, it has to be introduced in the first year of a 2-year session. So they introduce a placeholder bill, which basically is a shell bill that they use to merge things into at some point before the end of the second year if they need that as a bill, because they can always say that it was a bill that was introduced. It just doesn't have a lot of meat to it. They could bypass that, but then they have to go back and request a waiver of the rules in the second year. So they normally, as a practice, throw in a placeholder bill. It's just kind of an empty shoebox, and they'll use that to put these bills in. If these bills move any place, they may combine them all into one bill at some point in the future, either this year or next year, put it in that placeholder bill number, and then move it forward to the floor or to final reading and on to the governor if it goes that far. But item 3, what they're finding out in this process with the legal counsel for the Retirement Committee and NPERS and their legal counsel is that back when 447 was passed, and they separated the OSERS trustees from the OPS board and broke that connection because the two of them used to be kind of combined. They're finding out that there were a lot of things that they maybe didn't address and they didn't look at, and they're not sure who's responsible for it, whether it's OPS or it's OSERS. So my interpretation of this is, one is it's putting everything back into the OPS bucket. So if there's any liability or exposure out there, it becomes OPS. The other is that if this board has gone on record saying we really aren't real wild about the management merger, if you move it into the OPS board and it's a subcommittee of the OPS board, that reluctance to move forward with the merger probably goes away because it's the right hand of the OPS and the left hand agreeing that the merger is something they want to do, assuming all of those parts of the merger get approved or worked out, and then assuming the governor's content to sign the bill if it gets to him. So there's kind of a two-pronged function there. Item 4 on that list is probably the big, long bill that I think Senator Scheer recently referred to as a 160-page bill that tries to cover all of the details of the merger. And that'll get complicated because there's language differences and all of that. That's why it's a month or so ago it was up to 160 pages. So those are the bills that Senator Colderman said that he plans on introducing. He does not have copies of them yet because they're still up at the bill drafter's office, and some of them may have come back down to him, but as of noon today, he did not have copies of the bills. He said he would get those to us as soon as he has them available, and he's ready to drop them. He plans on having a hearing on all of those bills the same day. He would just have one, he'd probably start in the same order he's got here, and it's the old show up, and those that are in favor of the bill speak for it, those in opposition then neutral. What that method of testimony will be is yet to be decided, whether a lot of it's in person or whether it's going to be by Zoom calls don't work very well at the state. Their technology is not good at as we all know from some of those hearings starting in last September. So some of them may be you line up out in the hall and they scrub everything down from one person to the next, as you see them doing from time to time now. So that'll be decided as they go forward. But those hearings, he plans on having all 5 of them the same time, so there's no inconvenience to anybody. They can all show up and testify in whatever position they want in each one of those different bills that are set for hearing that day. So we'll know more once the bills are dropped, but then the hearing schedule will come early. Senator Colderman said he did want to try and get these dropped fairly early so he could have the hearings fairly early. So if any of the bills or all of the bills work their way through to final reading, he would hope best case scenario is sometime April, 1st of May, that these bills could be voted on final reading, and either if they never make it there, they don't make it there. If they do make it, then they go to the governor, and the governor can sign or whatever he wants to do with it. He does indicate in these that they would carry the emergency clause, so that means as soon as the governor would sign a bill, it means the bill is then in effect. Otherwise, if it doesn't carry the emergency clause, it's 90 days after the session ends, or the other option is in the bills themselves, they have a specific date when in the bill or that section of the bill becomes effective. Like there's a transportation bill last year that has provisions that doesn't come effective until July 1 of this year, even though the rest of the bill already became effective. So those are the options there. The other option is that if these things get too confusing and there's a lot of opposition or there's pushback from any particular area, including the governor's office, these bills could drag and then just not get anything done this year, but because it's the first year of a 2-year session, they would automatically, if they aren't killed, would carry over till next year, and then they could readdress them next year in whatever stage of passage or rejection they happen to be in when the legislature ends. So there's a lot of unknowns out there, and this is not a simple issue. It's somewhat confusing. So that's kind of the state of the state on what he plans the committee would introduce and come into this session with affecting OSERS and OPS.
When you say that he's intending to have a hearing on this relatively quickly,
I can't hear where it's going, so I apologize.
when you say he's intending to have a hearing relatively quickly, does that mean in January? Does that mean in February?
He would probably try and with respect to the hearing date, he told me that he would try and schedule the hearing as early as he can. So theoretically, if these bills are dropped next week, and since he's the chairman, he could schedule them for the 19th, 20th, 21st of this month.
So is his intention to avoid having any public hearing, just have a railroad job to run the stuff through?
No. They every bill has to have a public hearing. So
but if you just get the bill on Tuesday and have a hearing on Thursday, there's no opportunity for the public to read the bill, understand the bill, develop testimony, and get to constituents informed.
No, that's a good issue, a legitimate issue, because if it's a 160-page bill, it was discussed by Speaker Scheer before he was no longer in the legislature. That's going to be a lot to digest. So the request to Senator Colderman would be, this is confusing, so let's kick it down the road at least a couple weeks so someone has a chance to evaluate this, because I don't know that anybody has seen the full copy of the bill as it's coming out of the drafter's office. I think there's been working copies that OPS and Kate Allen, the committee legal counsel, have been able to look at, but that's a constantly moving target. So
I understand the need to have hearings on bills, but I also understand the need for the public to have the opportunity to give meaningful input and not have the stuff railroaded through and having to buy a pig in a poke. Here's our bill, 160 pages, look at it, and by golly gosh, you're all in favor of it, aren't you?
Yeah.
That doesn't sound like a public hearing to me. That's going to be a railroad job.
Well, and we can express that concern with Senator Colderman. Said, look, if you're dropping a 160-page bill, the first bill, 1 and 2 are relatively simple. 3 and 4, which have a lot more detail to them, are the ones that you would say, hey, can we get a couple weeks or a month of time to look this over and see what's all in this to see if we're pro or con or whether we're neutral? It's a good point.
Other questions for Jack? So, Jack, do these 5 bills, reflect the work of the Better Together Coalition? Do you know? They don't?
Could you speak closer to the mic?
believe we got notification last Friday that was it Friday? I think it was very soon. Might have been Thursday. No, before when was that? I'm sorry, we had a holiday last week, didn't we? So it must have been the 30th. 30th was a work day. We got notification that we were going to be called to a meeting on Monday. We had the meeting Monday afternoon. At that time, we received this information. I think a couple people had gotten it. I know that Gary and Kate had been working, and I think he was called in to get sort of a preview, but that's how we got notification of it. And Ms. Richards also got notification, but it was right before the weekend, and we had the meeting on Monday. So some of it was a surprise. actually, all of it was a surprise. But it was very clear in the meeting that this is how it's going to go, and please sit up and listen. And that's what we did.
Thank you. Thanks for the clarity. Any other questions? Jack, how do you see I see the redistricting is going to happen this year. The redistricting is going to happen this year. Redistricting?
Yeah, that's a good point. There was some concern because I think the redistricting that's government military veterans, I think. There was some concern on that. The committee members are Brewer, Blood, Holleran, Matt Hansen, Megan Hunt, John Lowe, Rich Pauls from the Omaha area was on that, and Sanders. In the configuration of those committees today, early this afternoon, Pauls went off and Senator McAllister went on. And there was the political concern there that we don't want to stack that with real conservative folks that have a different perspective than more liberal folks. And so Senator McAllister moved on. I think Senator Pauls, I don't know whether he traded with somebody or what, but Senator McAllister is a Republican, but is not, how do I put that? He votes a lot of times independent, and so there's some concern in the Republican Party that he isn't really Republican. I guess they call us a rhino or something. So I think that's for the redistricting. Senator McAllister will be good because he's one that you can talk to. He's open-minded and he's always looking for a sense of fairness. So that is going to be a committee that's going to probably catch some concern and heat this year with what they have to do.
All right. Additional questions for Mr. Peets? Seeing none, thanks. Appreciate the update.
Thank you.
Okay, next item on the agenda is the Executive Director's Report. Cecilia?
Okay, just 3 items. Just to let everyone know, the office is still working on a split shift through January with remote, only 1 or 2 people in the office at a time. Just so the board is aware, we did have what I've referred to as a breach of security. We had an OPS staff person found in our office suite one evening. And their reasoning for being there was I was just looking around. So I'm working with Dr. Sturber, and we're installing additional locks. The retirement estimates request has been increasing. And since September, so staff has informed me that since September 1, 2020, we've calculated over 100 requests. Now, that doesn't mean 100 people are ready to retire, but they are to the point of thinking about it. And just for the record, bless someone's heart, last year I told her, you will know when it is time. And she emailed me yesterday, and she said, Ms. Carter, I now know it's time. And then since the new year, so I said 100 since September 1 of 2020, and since the new year, we've done approximately 25 requests of people asking for retirement estimates. So, I think people are still struggling with everything that's going on, and if they are eligible, they are looking at their options. That ends the executive director's report.
All right, thank you. We'll move on to the trustees' report. Anyone have anything?
I do have one item. I would like to call your attention to the passing of Art Johnson on December 24th. Art Johnson served on this board for a number of years, probably longer than anybody in history. He was one of the original trustees back in the 1950s when they had a fairly limited list of investments. He was worked for, I think, Guarantee Mutual Life, one of the insurance companies here in town, and his job essentially on the trustees was to select the bond portfolio that they were able to invest. He maintained his position on the trustees for approximately 30 years, ending up as chairman of the trustees, or president of the trustees, during his last few years after he retired. He retired, I think, just before John Erickson came on.
So about 2007.
About 2007. He was an icon, and he'll be missed.
Thank you, Roger. Anyone else have anything for the good of the group? Okay, seeing none. I know we have a couple matters to discuss in closed session, so I guess I'd look for a motion to go into closed session. Okay, we have a motion. Could I get a second?
Second.
We have a motion and a second to go into closed session. Cecilia, would you call the roll?
Bourne,
Yes.
Havlovic,
Yes.
Hersenbach,
Yes.
Johnson,
Yes.
Logan, Plachek, Ray.
Aye.
7 ayes.
We are in closed session.
Okay, she's ready. Go ahead, Matt.
Okay. Yes, sir.
Oh, wait, I'm
Hold on
sorry.
one second.
I'm sorry.
So we're out of closed session, so Cecilia, would you call the roll?
Sorry. Okay, Bourne,
Here.
Havlovic,
Here.
Hersenbach,
Here.
Johnson,
Here.
Logan, Plachek, Ray.
Here.
7 present.
All right. We'd now look for a motion to adopt the payroll, retirements, death, and refunds.
Ratified January pension payments in the amount of $11,314,819,000, $5,086 pays. Approved January staff payroll in the amount of $31,836. Approved 22 new retirements effective January 1st, 2021. First pension check paid February 1st. Ratify the termination of 20 retirements due to the death of the retired. Approve the January refunds, $598,693.40 former employees and individuals. Approve the payment of October accounts payable in the amount of $22,000.
Okay, we have a motion. Do I have a second?
Second.
We have a motion and a second. Any discussion on the actions?
Just for the clarification, that is January's payroll. I apologize.
Okay. Cecilia, call the roll.
Ray,
Aye.
Hersenbach,
Aye.
Logan, Havlovic,
Aye.
Plachek, Johnson,
Aye.
and Bourne.
Aye.
7 ayes.
Okay, it is approved. So moving down to new business, I just kind of wanted to discuss the audit a little bit. So if you look back at the document that Jack Peets had given us, it's really not 100% clear what the parameters of the audit are. We asked for an RFP, a sample RFP that the Emperors had used in the past. We have not gotten that yet. We don't have the parameters that the bill is going to call for in terms of what would be in that audit. So I would anticipate that we would have enough information to discuss that and put out an RFP at the next board meeting. That's kind of the thought. I think it's kind of hard to put out an RFP unless you know the total, curbs of the audit, right? So wanted to give everybody a heads up that that's coming. We've never done an audit, a compliance audit, and apparently it's because it's never been required. And so it makes sense that it's good practice, but again, we don't have enough information to construct an RFP. It could be that it's under the level that would require an RFP, so we'll have more information at the February board meeting. So wanted to bring that up to your attention. Is there any other items for discussion under the new business section?
I had a question about that compliance audit costs. It appears from this outline that they gave us that the per board is going to conduct the compliance audit. We will not. Is that how that's going to work, Cecilia, or is that going to be something we'll be in charge of? And if so, who's going to pay for that? I thought it looks like they're going to bill the OPS for the compliance audit. Is that? I'm sorry, I can't hear you.
The plan would pay for the compliance audit. What we heard from Oren was that, because I've asked questions about why this didn't come up in the LP31 study, because to me that's where it should come up. And their response was they just made an assumption that they were done because all plans do them. So it was shocking, for his words, not mine, that a compliance audit isn't done at a regular cadence for the OSER plan. That's what happened. That's what he shared with us. And the plan pays for the audit.
Well, it indicates on the outline that PERB would have the authority to bill OPS for the services. That's one of the services that looks like they're putting in this audit requirement. Is that not going to be the responsibility of OPS then?
I just shared with you what was told on
Roger, I think I can answer that, kind of. I think what that means is after you do the compliance audit, they'll sit with Oren Hill and NIPERS, and they'll go through the compliance audit. NIPERS will go through it. I think at that stage, Dr. Logan, OPS picks up what NIPERS charges to go through the compliance audit and make sure they're satisfied with whatever needs to be remedied. The OPS does not pay for the compliance audit itself, but if NIPERS or the per board has issues and changes, that falls to OPS. I hope I said that right. That's the way I understand.
To be honest, I'm sure you're remembering it, and I remember it just different. So
that's the way I understood it. I don't.
In fact, it came up a few times during the phone call, and my recollection is that.
What about cost? Say again?
Yeah, I was on the call. I don't remember that. I remember the audit itself was going to be paid for by the plan. I don't remember that last line that talks about PERB authority to bill for their work. And so we'll get clarity.
Yeah,
we'll get clarity.
We'll get clarity on that.
Yep.
What about the audit from the public auditor? Isn't that the same audit that we have done by our auditor that does the school district books and our books as well?
Pretty close to it.
So why would we want to have the one done by the state auditor? What's the advantage of having that done?
Yeah, again, I don't have enough clarity to answer the question. I think that's kind of why we were going to wait till February, but it's not clear to me what the difference between the two audits is. If one's more extensive or I'm not sure.
Well, OSERS has never done a compliance audit, and I don't believe they're staffed for that. So is that going to be done by an outside firm then?
Yes.
Yes.
And then we'll just be stuck with the bill? That sounds like an unfunded mandate to me, but nonetheless, I guess that's the way state government works these days. I'm not sure that this. I don't know if you say this is not something that the BTC has endorsed, or this got dropped on you, and that's about how it happened. Is that correct, Dr. Logan?
Yeah, we were called to a meeting, and that's what we got.
Okay. Ordinarily, when bills have been involved and put into the bill a hopper that involves OSERS, OSERS itself has been involved in the development of that bill in some fashion or another. I'm a little bit concerned that this thing is being generated by people who are not part of OSERS and apparently are working behind the scenes and not in public. And no one knows what's going on until the last minute. And then they're saying, don't you agree? That's not the way bologna should be made for the retirement system. That's the way bologna is made, all in the dark. I'm just very uncomfortable with this, the way that the process that this is being used to develop this legislation. Let me just talk a little bit about the unfunded liability. We talked at the Aon people mentioned about lowering the assumed rate of return. I mentioned this before, and I guess I need to mention it again. I don't know why OPS or OSERS members should be responsible for shortfalls in the investment returns, now that the investments are being handled entirely by the state of Nebraska. Every retirement system in the state whose money is managed by the investment council has the unfunded liabilities that are a result of a shortfall in earnings picked up either by the state or by they'll find a way to get it done. I'm not sure why OSER should be treated any differently, even if we're not part of the state system. Our money is managed by the state. Shortfalls in investment return are typically the responsibility of the employer or the agency that's involved with investments, and that's not us. I think we ought to insist that that be part of a bill that might be affecting OSERS going forward. And I hope that the school board itself will take that up as part of the legislative package. I think I'm through for the moment.
Okay, any other comments by the board? Seeing none?
I gotta say one more thing. I'm not sure. I know what Jack said about the dissolving of the OSERS board and having it go back the way it was before. I'm not sure I understand that. I'm not sure I understand what the reason is to have a brand new board appointed by the Board of Education with no experience in retirement matters to essentially shepherd the system into the state system. I don't see how that is in the best interest of the members. I don't see how that's in the best interest of the plan. I'll just make that comment and let her go with that.
All right, thanks, Roger. Any other comments, questions, concerns? Okay, with that, we'll conclude the meeting at 5:44 p.m. Thank you.